Analysts have flagged the risk facing the banking sector as a result of the ongoing global monetary policy tightening that's aimed at fighting world inflation. Experts say the aggressive interest rate hikes are now taking a toll on banks, saying cracks are starting to show. Portfolio manager at Foord Asset Management, Rashaad Tayob, speaks to us about this. Thank you so much for your time, Rashaad. The starting point really would be, where are these cracks within the banking system? In the US, we saw the collapse of at least two prominent banks, and that has been attributed to what has been taking place in terms of monetary policy tightening.
Yes, it's actually around 5 banks which have basically been gone under in the last 6 weeks. So it's a very significant problem. You've seen the second and third largest banking crises in the US in history. So I don't think one should estimate the effect of what is going on. And it's happened because the Fed has taken interest rates from 0 to 5% in just 14 months. So when you have that extreme move in interest rates, you find that banks effectively, when interest rates go up, the value of loans, the value of bonds that they hold fall. And what has happened is that they've depleted their entire capital, and large portions of the US banking system is effectively insolvent. And it's no surprise that when you see evidence of weakness in a certain bank, it starts a bank run, depositors begin to pull out of their banks, and the bank is forced to be wound up in a very short space of time. So you've seen some of the weaker banks already fall over, but with depositors leaving in search of higher rates, I think you can see continued pressure on the banking system given the level of rates at the moment.
Could there have been no cushioning whatsoever on the side of the banking system as a standalone, as well as central banks? Because we knew that this would ultimately be the result of the aggressive interest rate hiking cycle that we've seen. But at the same time, banks were expected to be as resilient as they were in the 2008-2009 global financial crisis. And that was not the case this time around.
Yeah, it feels like a bit of deja vu, like why are we going through this again when we've already been through this in the financial crisis of 2008? This problem should have been fixed. But unfortunately, they're slightly different this time around. That time around was specifically the credit losses from the housing crisis. So you saw a big fall in housing prices that caused credit loss on a range of banks' books, as well as mortgage-backed securities. Here, it's not losses from credit, it's actually losses from interest rates. So when interest rate goes up, the value of future cash flows comes down. Effectively, the value of your loans and bonds fall. So it's a little bit of a different problem. But what you've identified is true. The regulators were effectively sleeping at the wheel, because when they do their stress tests, when they give their monthly confirmation that the banking system is fine, they've actually been giving the banks an okay. Meanwhile, they weren't even stress testing for interest rates. So even the regulators were reckless, and they didn't effectively control the risks within the banking system.
So, Rashaad, how is this playing out in the South African banking system? We can't compare the two. The US and South Africa are two different environments. But what pressures is the domestic banking sector facing as a result of the hike in interest rates?
So our banking system is structured quite differently. In the US, they give a lot of fixed rate loans. So when you take a mortgage out, when you take a home loan, it's actually fixed for 30 years. That's quite unique. When they lend money to corporates, they do it on a fixed rate basis. In South Africa, we run very much a floating rate system. So the banks borrow at a floating rate and they lend at a fixed rate. If you look at your home loan, home loans in South Africa are linked to prime. And when the interest rates go up, the bank has to pay more on its deposits, but at the same time, they get more in terms of the money they loan. So it's very naturally hedged, unlike the US banking system, which is run on a fixed rate system. However, you can see the evidence in South Africa. We have had a very poor economy. You've had the prime rate go up from 7% to 11.25%, and now you are starting to see that effect take place in the home owners market, where missed mortgage payments has increased dramatically in the last few months. So the consumer in South Africa is under pressure. The economy is weak. And the effect that the issue that we have is not so much interest rate mismatch, but it's rather the weakened economy and what effect is that having on the consumer and the homeowner that's causing them to start to miss payments.
That local dynamic that you just alluded to, Rashaad, is it a better one or a far worse off position? Because both sides essentially have their hands tied and economic participation then shrinks, and therefore ultimately the domino effect is that the economy is not going to grow as fast as we need it to get to a stabilization point.
Yeah, I would argue that the South African system is naturally more resilient. So in the US, they are far more sensitive to big changes. So if you look at the US, they are the dominant global economy, they are the reserve currency, and therefore they were able to run a relatively unique system where they were able to lend to homeowners and lend to corporates for very long term at relatively stable and fixed rates. But the problem is when you have an interest rate increase that we haven't seen since the 1970s, you begin to see the cracks in the system. So I think they were living in quite a unique system with certain privileges of being the globally dominant economic force, whereas in South Africa, we didn't have that privilege. We are subject to a range of risks that emerging markets face in terms of capital flows, in terms of commodity flows. So we could never run a system like they have, but at the same time, our system is relatively more resilient. It's not necessarily going to blow up because of interest rates. In South Africa, we're used to interest rates going up dramatically. We're used to the rand depreciating. We've seen double-digit interest rates many times over the last 2 decades and even much higher before. So I think by our nature, we are more resilient to economic shocks.
On that note, and lastly, Rashaad, the near-term outlook worldwide when it comes to interest rates, where do we stand? We are in the month of May, and already we were expecting some sort of a pause from the U.S. Federal Reserve when it came to monetary policy tightening. That was not the case when we heard from them last week, along with the European Central Bank, and we are expecting to hear from the South African Reserve Bank later on this month, and the expectation there is of another hike.
Yeah, so, we saw an interest rate hike of 25 basis points from the Fed last week, which I think was a little bit surreal because you saw the First Republic Bank effectively go insolvent on Monday, and on Wednesday they're hiking interest rates. So it was quite a strange situation whereby they really focused on fighting inflation and that part of their mandate, but in terms of the financial stability side of it, they're less focused on that. However, when we've gone from 0 to 5% in a short space of time, one could argue that the majority of interest rate hikes are behind us. I think that was the last hike from the Fed, although some people say we could get maybe 25 or 50 basis points more. But even if that is possible, you have to acknowledge that the majority of hikes are behind us. And it's similarly from the SARB. We've gone from 3.5% on the repo rate to 7.75%. It could be another 25 or 50 basis points because our inflation remains elevated. The governor has spoken very strongly of wanting to get inflation to the midpoint, the 4.5% or even lower, which is a very aggressive target, and that might induce them to hike more. But the toll it's taking on the global economy, the South African economy, our expected growth this year is less than 1%. It's a very poor state for an emerging market. Globally, you're seeing banking crises happen. So it shows you that we are getting towards the end of the hiking cycle. They are taking their tolls, and the global central banks do need to calm down and let these interest rate effects take shape, because it does take time for them to filter through to the economy. So I do think it's time to pause and look and see what happens in terms of inflation and growth before continuing to hike aggressively.
Thank you so much for your contribution. Rashaad Tayob is Portfolio Manager at Foord Asset Management, talking to us on the business desk this morning about the impact of hiking interest rates on the global banking system.